Would John Bogle invest in U.S. stocks today? Maybe not, says Brett Ahrens from MarketWatch. Dateline February 20th, 2021. So anytime I hear about John Bogle, I get interested, especially saying the Vanguard founder probably wouldn't be a fan of this high-flying market. Interesting. So here, U.S. stocks have outperformed international for the past decade. Is it time for an international again? All right, so what is this, 100? So U.S. stocks is on the upside. Okay, so here U.S. stocks is relative, total return relative to the MSCI EFA. All right, what's that? Europe, Asia, Far East, Europe, Australia, Far East. I forgot, that's just the ex-US essentially for developed markets. I think it's Europe, Asia, Far East, if memory serves, or Europe, Australia, Far East, I can't remember. Anyway, so here is the EFA right here outperforming us up until about 1998. And then here we are until about 2005. And then over the last, 2012, we've smoked them. Is that right? Let's read this. All right. Investing in U.S. stocks had fewer bigger fans than John Bogle. If you hold the stock market, you'll grow with America, he said in 2018, a year before he died. He famously suggested keeping things stupid, or keeping things simple, stupid. Invest through low-cost index funds. Don't get too clever, hoping to beat the market with big swings, and just stick to U.S. stocks. He saw no particular reason to invest internationally. So what would he make of today's high-flying stock market where the Dow, the NASDAQ, the S&P 500, and the Russell 2000 all are skyrocketed to fresh highs? All right, we're always at fresh highs. This is what drives me flipping insane. The market was here, then it goes to here, we're at fresh highs. Then it goes to here, we're at fresh highs. Then it goes to here, we're always at fresh highs, man. Sometimes it backs off, but the market, the trajectory has been like that, which means the market is always at all-time highs until temporarily it gives up the high and goes back to lower than what it was before. But in theory, historically at least, the highs are permanent, the gains are the losses are temporary. This guy hazarded to say that Bogle wouldn't be a big fan. I bet he'd be warning investors to take a second or third look at the risks they're taking in their retirement accounts. Where according to Vanguard, about 2/3 of the average portfolio is just U.S. Well, that's not as bad as I would have thought, man. I mean, only 2/3 of the U.S.? Well, it would have been bigger than that. I mean, hell, 2/3 to 1/3 is about the extent I'd ever recommend anyone going international, domestic to international, and that seems pretty high to me. I don't have any international stuff, just FYI. And most intriguing, I wonder if he changed the habit of a lifetime and be willing to bet big on overseas markets instead of just the U.S. All right, so first of all, John Bogle never betted on the market. It's not a bet. It's an investment. Words matter, and this is where the left has dominated the right, because we always say, it's just a word, words don't hurt me. But words mean things. So that's just a fact. They have a meaning behind them. And to say John Bogle is betting big on something, no way he would attribute that to himself. He invests to grow with America. I'm not saying this because I've been back to Salem, Mass. to consult witch doctors or commune with the dead, because Bogle died in 2019. But we don't have to guess what he thought about U.S. valuations. 2 years before he died, he warned us that U.S. stocks are already so expensive that longer-term 10-year returns on broad markets were likely to be meager at best. He forecast about 4% a year. That, he said, was based on three things anyone could calculate, which had excellent long-term return of predicting returns. A long-term record of predicting returns. He started with dividend yield. This is the exact formula I use, man. Dividend yield, 2%. Growth in corporate earnings, he says about 4 to 5%. And that's where I get my numbers. And he subtracted a percentage point or two because he expected PE levels on the market to decline back towards their long-term average. That's in 2017. But here's the problem. Since then, U.S. stocks have already produced some of the returns he predicted for the next 10 years. His forecast implied that the Vanguard Total Stock Index would rise a total of 50% between March 2017 and March 2027. But it's already risen 70% with 6 years to go. Not to put too fine a point on it, but to hit Bogle's forecast would have to lose more than 2% a year through 2027. All right, so he predicted that the stock market, the total stock would rise about 50% in the next 10 years, but it's already risen 70, so it'd have to give up 20% of that gain over the next 6 years. Meanwhile, the numbers Bogle used to build his forecast look even worse than they did. The dividend yield on the S&P 500 is now 1.49, or a quarter less than where Bogle had it before. Corporate earnings are going to be hard-pressed to rise more than 5% a year. I completely agree. When the CBO is predicting total GDP to rise by less than 4% on year on average. Yep, and that's before inflation. And the PE ratio on the S&P 500, which was 18 when Bogle gave his interview, is about a fifth, 20% higher at 22. All of which means the risks are higher than they were 4 years ago and the outcome likely worse. There are important caveats. Bogle warned 7 times last decade about the rising U.S. stock valuations and the effect on long-term returns. His warnings were either wrong or at least premature. So you can figure the same thing applies today. Yeah, so Vanguard and Bogle have been saying the same thing for years, man. The GMO, same thing. That's the Jeremy Grantham. I mean, there's so many negative Nellies out there. Look, if you get 5 or 6% a year in stocks, I think you should be happy with that for sure. On the other hand, rising U.S. stock valuations pose a major potential risk to Americans' retirement plans. They may actually pose the biggest single risk because U.S. stocks dominate the average 401k and IRA, which brings us to the major alternative, international stocks. We're talking about developed markets like Europe, Japan, Australia, rather than the more volatile emerging markets. Vanguard says they expect the next decade compared with the last. We believe U.S. equity returns will be about 8 percentage points lower than the last decade on an annualized basis. If memory serves, though, I think Vanguard has been saying that for a while. I get their year over year, and I saved them in my PDF. I just can't find out from the previous years. I just forgot where I got them. But I'll go maybe one of these days. I'll research to find them. But they've been wrong, man. They've just been wrong. So, I mean, again, broken clock and all that. But still, at the end of the day, they've been high on or more bullish on international than actually has come to. They have just been way over optimistic international. They calculate over the next 10 years, U.S. stocks are likely to gain about 4.7 on average, which again is not including inflation. International stocks, they expect to average over 8% a year. That would work out to a total gain of about twice what you get on U.S. stocks. All right, but we've been here before. U.S. stocks beat international in the 1990s, and the decade just ended. But international stocks beat U.S. stocks in the 1970s, 1980s, and the zero. So here we go to the international stocks. Yeah, they beat in the 70s, the 80s, pretty much half the 90s, and then pretty much all the aughts. So basically, other than, I mean, you get what? No, friggin', what's that? 1998 to 2002. That's 4 years, and then you got 2012 to 2018, or 2020. So we got, what's that? 12 years of the last 50 U.S. stocks have beaten international. With that, that seems like the international stocks might have a lot more to give than U.S. stocks, frankly. Because international has done well relative to the U.S. stocks over the course of since my life 50 years ago. There's a great tendency in finance on Wall Street and Main Street to treat U.S. stocks as mainstream and forward stocks as somehow risky. And outre? I don't even know what that word means. Outre? That's true even when you're talking about stable developed markets in Europe and Asia. It makes no logical sense. The U.S. accounts for just 24% of global economic output, according to the IMF, but nearly 60% of stock market values. Personally, I wouldn't have less than half my portfolio overseas, even if I thought U.S. stocks were cheap. And right now, they're not cheap. Okay, well, that's okay. I mean, saying U.S. stocks account for 60% of valuation, but only 24% of U.S. economic of world output. There's a lot going on in that because we have capital markets. A lot of the world doesn't, and a lot of the world that even does, or capital markets are somewhat suspect in terms of private property rights and things of that nature. That's why the U.S. in terms of capital markets are better, because our capital markets are more secure, more rule of law, and they're older, man. it's just it's a weird thing. Anyway, I disagree with this. I completely disagree with that take, and I certainly wouldn't have more than 50% of my assets overseas. All right, like to hear your thoughts. We'll see you